Welcome back. When financial bloggers talk about the mistakes they've made, there's one common one that comes up all the time when they start their financial journey. And that's starting their investment journey with mutual funds at their bank. I did the exact same thing when I started my investment journey, and luckily for me, there were enough bloggers and YouTubers out there at the time to warn me about these sort of things that I didn't invest in mutual funds for too long, maybe a couple of years, 2 or 3 years before I made some switches and some changes to my portfolio. It's usually a really easy mistake to make. Usually when you want to start your investment journey, you don't have a lot of knowledge about investing. You don't know what to do. You don't know where to go, how to set it up, how to start it. Nobody talks about it. Nobody tells you how to do this sort of stuff. And so what do? You go to the bank. You think that they have more knowledge than you do, and so you want their advice. Usually all you're going to get when you ask for investing advice at a bank, you're going to get some mutual fund salesperson trying to sell you some high fee mutual funds. Now don't get me wrong, there are some things to like about mutual funds. They're easy, they're super convenient, instant diversification, right? But there's a lot of things not to like about them, and I'm going to talk about 2 of them, and that's the transparency and the outrageous fees being charged. So when I got started investing, I went to CIBC and started there. I banked with Simply, or at the time PC Financial, and they were affiliated with CIBC, and so I invested in mutual funds through CIBC. And so I'm going to use CIBC as an example. Usually I sort of pick on RBC just because they're Canada's biggest bank, so most of you are banking with RBC. All of these mutual funds are going to be very similar. I just have experience with CIBC, so I'm going to use them as an example this time. So when you go to the bank and you ask to get started investing, the mutual fund salesperson is going to give you a questionnaire. This questionnaire is supposed to tell them your risk tolerance. This is a ridiculous way to determine your risk tolerance, but they all do it. And the questionnaire is going to ask you how experienced you are with investing, how long will you hold it for, etc., etc., etc. And again, it's just a way to determine what your risk tolerance will be. Now, for the most part, what this questionnaire is going to tell you, or tell the sales rep, is that you are going to get a balanced portfolio. And what does a balanced portfolio mean? It means that you're going to be comfortable holding 60% equity and 40% bonds. So 60% risky, 40% safe for your fixed income stuff. Some will consider a 50-50 portfolio a balanced portfolio, so 50% equity, 50% fixed income. But for the most part, it's now a 60-40 portfolio. Again, this is a ridiculous way to determine your risk tolerance, but it's going to be what you see. So I'm going to show you an example of what you might be sold. So here is a CIBC managed balanced portfolio fact sheet. So when you go through this fact sheet, there's some things that you should be aware of. So the fund code, CIB 834. So when you get into stocks and ETFs, those will be called tickers, but for mutual funds, they're a fund code. It's just a way that you can research it and find information about this mutual fund. There's almost $3 billion invested in this fund alone. The MER, the management expense ratio, this is the fee that you're going to be paying the bank. I'm going to get back to this because that is a significant fee. And you can see the minimum investment. You have to put in $500 to start, but after that you can put in sums of $25 at a time, which is great. So you can see here that it's trying to invest in a 60-40 portfolio as stated. And on the right, you can see what the current holdings are in each of the different markets. So you can see 44% is in a Canadian bond mutual fund. There's actually 5% in an international bond mutual fund as well. So almost 50% of the portfolio right now is in bonds. So it's more of a 50-50 balanced portfolio right now. And there's probably going to be some rebalancing in the next little while to get that back to that 60-40 split that they are looking for in this fund. And you can see 18% is going into the US market, 16.5% is in the Canadian market, and 16.2% is going everywhere else outside of Canada and US. Now, one of the drawbacks of mutual funds is their transparency. So what are you investing in? And so you do some research and you look and it says that there's 13 holdings. And when you look at the top 10 holdings, it's just other mutual funds. And one of the big problems with mutual funds is that they always show only the top 10. what are those other 3 that you're investing in? It's so hard to find those other 3, and sometimes impossible to find those other 3. And because it's a fund that holds other mutual funds, you have to do some more research. So I dug deeper into the Canadian Equity Value Fund Class O. So 8.2% of your holdings is in that. So let's look at that. And so here is the fact sheet for that mutual fund. And again, you can see that you hold the RBC, TD, Bank of Montreal, Enbridge, Railways. And again, it's just the top 10 holdings. It looks like it's following the TSX Composite Index, but you have no way to know that for sure. It just tells you the top 10 holdings. You actually have no way of knowing all the different companies that you're actually investing in. And again, the biggest problem is this 2.25% MER, the management expense ratio. For every $10,000 you have invested, they will take $225. Doesn't sound like much at the time because someone's in the back doing stuff for you. But if your portfolio grows to 100,000, now you're losing 2,250,000. And if your portfolio keeps growing and growing, there's more and more and more money taken out to the bank. Now, I had a guest speaker from a bank come and speak with the students about mutual funds, and she actually said that people that invest in mutual funds don't pay me a fee. That's what she said. No one pays me a fee. And so I started digging deeper into that, and I said, you don't do this for free. Like, how are you getting paid? She said that 1% of this management expense ratio actually does go to her. And so what happens is this 2.25% is just an invisible fee that you actually never see money taken out of your account. You just lose it basically every single day. So 1/365th of 2.25% gets taken out of your account every day. So you're actually losing that money secretly. And that's how they're getting away with this. It doesn't look like you're paying them because they take it before they put it into your account. Morningstar.ca has a great website. I use it all the time for comparisons and some research. And you can see here is 3 lines. So we're going to look at the red and the blue line. The red line is the index that this fund is trying to follow. So CIBC has chosen some index to come up with these percentages on the right and follow that and just mimic what that index is doing. So if you were to just invest in that index, your $10,000 would have grown to $18,856 over 10 years. So about $8,800, almost $8,900 over the 10 years. But your mutual fund actually only grows $6,584. So you lost $2,300 over a 10-year period from that $10,000 just from those fees. Even more significant, Michael James on Money, he has a great blog site. I subscribe to it. I'm excited every time he's got a new blog post. He's a big numbers guy. And what he did was he wanted to calculate what is the long-term effect of these MERs. And so what he did was he came up with something he called the MERQ, the management expense ratio quarterly. So a quarter of a century. So every 25 years. How much of an impact do these MERs have over a 25-year period? And so if you look at, let's say 2.2%, which is close to the 2.25, the MERQ is 42%. That means that 42% of your growth is gone over 25 years to the bank. So if you were supposed to get $10,000 in growth, you actually only get $5,800. That is significant. Almost 50% of your growth is gone. I'm going to have videos later on to show you how you can invest in a balanced and diversified portfolio in this area here, the 0.1, 0.2, 0.3% range for MERs. And now you're losing a significant amount less than with these mutual funds. So that's one regret most investors have when they're starting out, and that's investing at the bank with mutual funds. I will have more videos on how to avoid this and invest in different ways. If you've enjoyed this video, please subscribe below and have a wonderful day.